Okay, so hello, I would like to welcome all participants to this webinar, which is part of the Advanced Corporate Finance course for the master students specializing in corporate finance and banking at the business school, EDHEC Business School. So today we have the pleasure of having Alex Edmans with us to discuss business social responsibility. Alex began his professional career in investment banking at Morgan Stanley, like most of you, but then went to obtain a PhD in finance from MIT, unlike most of you, after which he became a professor at Wharton and then came back to Europe and joined the London Business School. We all know that Alex is a great professor, but Alex is much more than that. He is a keen athlete, a marathon runner, and have completed a half Ironman. He also plays music at the second largest church in London. Alex is an excellent researcher publishing in top tier academic journals, but unlike most of top finance researchers, Alex writes papers that people can actually read and understand and even have fun with it. My favorite one is sports sentiments and stock returns, where he shows when a country loses in a soccer game, the next day its stock market also suffers significantly from the loss. So here is the message to our French student: instead of being so angry after France loses, maybe it's not a bad idea to go and buy stocks right away. No, don't, I'm joking, but you can take it. Alex has a recent paper where he's showing that the country's music sentiment, measured by positivity of songs that people choose to listen in Spotify, is positively correlated with stock returns that week. So perhaps the message here is try to be always positive. Alex's most cited and well-known paper, which is actually related to his talks today, is the one showing that investing in companies that treat their employees the best earns a significant positive return. The interesting thing about that paper is that it was written when talking about business social responsibility in the finance profession was definitely not so welcome. But to me, what makes Alex really unique is, I want to say a word and phrase that is not, maybe you are not familiar with, is his personal social responsibility. Let me highlight a few aspects of it. We all know that teaching is something that has way more social value than personal value to professors. As a result, profit maximizing professors put as little effort as possible on their teaching duties. But Alex is one of those who take teaching seriously, winning 14 teaching prizes in only 6 years at Wharton and several others at LBS. And I seriously doubt that Alex can explain his decision to spend so much effort in teaching based on maximizing his personal income. But it's even more than that. Alex truly cares about his students so much that he plays, or at least used to play, rock music for them in class. Even outside the class, he takes students with him to the boot camps and trainings. And honestly, this level of personal social responsibility is unique to Alex. Another example is Alex's efforts to fund and support social entrepreneurs who wants to make a positive impact on society. One out of many such cases is Luminary Bakery, which provides employment and training to women disadvantaged through poverty, homelessness, violence, or crime. Last but not least, writing amazing books also typically have way more social value than monetary personal profit to the author. Alex's recent book, Grow the Pie, how great companies deliver both purpose and profit, was named to the Financial Times Best Business Books of 2020. I'm sure the opportunity cost of that time spent on the book was very high, but Alex decided to sacrifice it, writing something that brings much more value to the society. What a great pleasure to have such a brilliant thinker with this level of personal social responsibility talking to us about business social responsibility. Thank you, Alex. The floor is yours.
Thank you so much, Hamid. It's fantastic to be here, and thank you so much for such a generous introduction. So I gave a guest lecture at EDHEC last year, really enjoyed it. The engagement from the students was fantastic with some really great questions. Really delighted to be back this year. And as Hamid says, what I'm going to speak about is business social responsibility. And this is a really important topic. But many people who focus on business social responsibility highlight the moral and the ethical case. And that is clearly important, but I think what's also important is the business and financial case. So as Hamid says, we do things because they're the right thing to do. We don't do things just to make money. But it is useful to know that there is a profitable byproduct of this, because otherwise, if you're a chief executive, you might think responsibility is secondary to running the business. So what I hope to show you, and I'll speak for about 35 minutes before questions, is actually responsibility is part of the core business. It should be central rather than peripheral. Why? Because it's good not just for society, it's good for business success. And so there's three parts to it. What is responsible business? Does it actually work? And then how to evaluate it if you're an investor and trying to figure out which companies are truly responsible. So let me start by what is it? And you might think, well, that's kind of obvious. Why do I even need to tell you what a responsible business is? But in fact, I'm going to have a slightly different view to what you typically hear. So to explain this, let me just tell you a little story. Let me take you on a journey, perhaps away from your home offices, to halfway around the world. I'm going to take you to the Great Rift Valley. So this stretches across 2 continents and 6,000 kilometers from Lebanon in Asia to Mozambique in Africa. And it has some of the world's highest mountains like this one, but also some of the world's deepest lakes. And one of these lakes is a lake called Lake Magadi, which is in the Kenyan part of the Great Rift Valley. Now you might think it's hard to imagine that you're here because you haven't seen it before. But in fact, some of you might have seen it before, not on the small screen of your laptop, but maybe on the big screen of a movie theatre. It was featured in The Constant Gardener, which came out around 15 years ago. And indeed, millions of people around the world have seen this lake because they've seen this movie. But fewer than 1,000 people call the lake their home. One of these people is a gentleman called Emmanuel Saronga, and he makes a living selling and herding goats. Now, for Emmanuel, it used to be that cash was king. So when he sold a goat, he would get cash, but he then had to check that cash in case it was forged. He'd store that cash and worry about it being stolen. And then to bank that cash, he had to walk for an entire day to the nearest bank. So his life was really tough. He couldn't graze his goats on the greenest pastures. He always had to be within 1 day of a bank. But all of this changed due to a responsible business. And that company is Vodafone, the UK telecoms giant. Because in 2007, Vodafone launched M-Pesa, which is a mobile money service. Now, let me explain what mobile money is, because some people think it's mobile banking. I have a bank account and I can operate it on my phone. I don't need to go to the branch. But with mobile money, you don't even need a bank account to begin with. And that's really important because at the time, 15 million Kenyans had no access to banking. So this completely transformed Emmanuel's life. Right? He didn't need to deal with cash. He could just transfer money on his phone from himself to his suppliers or receive payment from his customers. He can just now graze his goats where he wants to. He doesn't need to worry about robbery or forgery. And as academics like Hamid and I, most of what we do is large-scale research, not just based on one simple story. So indeed, there was a large-scale study finding that in the first 7 years of the launch of M-Pesa, 200,000 households got lifted out of poverty, and many of them were headed up by women. It allowed them to move from agriculture to business and retail. So that's one story I'm going to tell you about Vodafone. But I'm now going to tell you a quite different story. And this different story surrounds tax. Because in 2012, Vodafone launched a tax transparency report showing how much tax they were paying to governments around the world. And in fact, they were the first telecoms company worldwide to do this. And that's really important because in telecoms, you could choose to locate your licenses in low tax jurisdictions. So why am I starting my talk with these two stories? It's to ask you all the following questions. First is, which of these decisions, launching M-Pesa or launching the tax transparency report, created most value for society? The second is, which of these decisions, if you had not taken them, would have led to the most public anger or worsened Vodafone's ESG rating or reputation? I'm not going to poll anybody. We're going to have a lot of time at the end for questions. Why I'm not going to poll anybody is most people agree with the answers. Right, let's start with the first question. Which decision created most value for the society? Most people would say it was the first one. Right, by launching M-Pesa, Vodafone lifted 200,000 households out of poverty. And also they contributed to gender parity. But let's now turn to the second question. What would have been the outrage? What would have been the anger if Vodafone had not launched M-Pesa? It would have been nothing. Right? You don't get slammed by the media for not launching an innovation. You don't suffer a customer boycott for not coming up with this crazy idea of banking without a bank, because nobody would ever thought it was even possible to begin with. But what is the outrage from not being transparent on taxes? It could be massive. Indeed, Vodafone themselves had suffered a nationwide boycott of their stores a few years earlier. So this is why my view of responsibility is slightly different to what you've seen before. So often people think that responsibility is about the answer to the second question. A business's social responsibility is to do no harm. They should not pollute the environment, they should not cheat on taxes, and they should not mistreat their workers. And absolutely, please don't get me wrong, those are all important things. Any responsible business should not create harm. But I think in 2021, it is not enough for a business to just do no harm. It needs to actively do good. Why? The problems in the world are so large that a company needs to actively try to address those problems. And why is that? Well, there's the moral case. We need to try to solve these problems. But there's also the business case. And that's what I'm going to focus on now before I move to the next section. So we often think that the value that a company creates is given by a pie. And that pie can be split either to investors in the form of profits or society in the form of taxes to the government or wages to workers. And often people think that a responsible business is one that splits the pie more fairly. Right? So you might donate to charity, you might pay more to workers than you can get away with, than you need to, and so on. And indeed, fairness is really important. But there's two problems with viewing responsibility as being about fairness. The first problem is, if this is what responsibility is about, then it reduces profits. And therefore, many CEOs won't want to do it. Why would you do something that makes you less money? And indeed, we saw 2 years ago, 181 CEOs signed the Business Roundtable Statement, pledging to serve wider society, but many of them just didn't put it into practice. And why would they? Right? Because if it makes them less profitable, let's just not do it. Let's just sign some nice things and not actually execute. Now, the second reason why responsibility can't just be about splitting the pie more fairly is that it's bad for investors. Now, some people think, I don't care. They like to see investors as nameless, faceless capitalists. Investors are them, society is us. If we can take from them and give to us, then everybody's going to be better off. But as I'm sure you'll all know, investors are not just them. They are us. They include pension funds saving for retirement, parents saving for children's education, maybe the EDHEC endowment saving to fund future research and teaching. So any responsibility of business must take the investors seriously. And so this is why my view of responsibility is that it's about growing the pie. So we absolutely do want to increase the orange. We want to make stakeholders better off. But the way we do that is not just by giving them a higher slice of what's already there through donating to charity, but by actively creating value through innovation and excellence, coming up with some crazy ideas like banking without a bank. Why? Because even though Vodafone genuinely launched M-Pesa to solve a social problem, not to make money, ultimately they were able to monetize it and benefit from it. And this is why I think responsibility is so powerful. So what we learn in finance textbooks, and probably what you learned in your first finance course, is when you make investment decisions as a manager, what you do is a net present value calculation. So you might think, well, if I make this investment, how much more money will I make? Now let's apply this to Vodafone launching M-Pesa. Is there money to be made by launching this mobile money service? No. Right? It probably won't work. Nobody's tried it. Even if it does work, there's going to be the danger that maybe people are going to use it for money laundering. There's going to be huge reputational risks. And also, even if it does work, then will we be able to actually monetize it? Because these are some of the poorest people in the world. So clearly, a company motivated by profit would not make that decision. But one motivated by purpose, trying to serve society, would do. And it leads them to taking a decision which ultimately becomes profitable. But you would have never taken that decision to begin with, were you just focused on profit. Okay, so at this point in my lecture, which is a third of the way, and you might think, well, everything I've said sounds great, but where's the evidence? Does it work? Well, I seem to be saying, just care about serving society and magically some profits will appear. But where's the evidence? Well, I've chosen you one example, Vodafone, but how do you know that this is not just one hand-picked example that I've chosen because it supports what I want to say? So most of what Hamid and I do is, in addition to teaching, is large-scale research. And the most important thing about this research is it needs to be very rigorous because of this concern of confirmation bias. So what is that? That's the fact that people would like to accept evidence if it confirms what they would like to be true, right? So everybody wants to believe that ethical companies pay off. And therefore, if you found a paper showing that ethical companies pay off, then you might just latch onto it, even if the study is not actually that rigorous. And so a few years ago, I gave this TED talk, What to Trust in a Post-Truth World, about how careful we need to be about a topic we feel strongly about, because if we feel strongly about that topic, we are going to latch on to studies that claim to support our view of the world. And if you just look at how this has panned out in terms of responsible business, earlier this year, my LinkedIn feed was just going crazy because of this new study claiming that sustainability always pays off. So here was a leading UK investor saying, is there anyone left on the planet who thinks that sustainability requires a sacrifice in return? And you have to be an alien if you don't believe this. And then people just falling over themselves to agree with him, right? This is very broad, thorough, infallible facts, robust proof, when actually the study had really basic errors. Then, a few months later, you found arguments of the opposite. So this organization, Scientific Beta, which I think is based at EDHEC, said there was no evidence that ESG strategies outperform. None at all, not even one strategy. And then most recently, I'm sure you'll know Tarek Fancy, the former BlackRock head of sustainability, claimed that the entire sustainability industry is PR, it's a distraction. But these are black and white views. And because they are black and white views, they get a lot of attention, right? Anybody who believes in responsibility is going to like and tweet and share this study. And anybody who doesn't believe in it is going to like and tweet and share this, which is why Tarek Fancy's article has become so powerful. But what I wrote to the Financial Times is, well, to avoid such binary thinking, things are either black or white, let's pay attention to studies based on how rigorous they are, rather than whether they support our viewpoint. So indeed, that's what I'm now going to do, is to look at the evidence. Does responsibility pay off? Now, that's a pretty difficult question to answer, because you would think, well, how do we actually measure how responsible a company is? You might think, well, can't we look at their mission statement? But as we know, there's some companies which might have nice statements, but not actually put them into practice. So you might think, well, maybe the approach is to look at how companies actually do. Do they put their money where their mouth is? How much do they give to charity? How much do they pay their workers? But the problem with that is that it only measures the input, not the output. It measures how much you spend, but not the effectiveness of such spending. So I'm sure some of you are sports fans, like football teams that buy a lot of players aren't always the ones that do best. And also, more seriously, some of the things that do a lot for society might not cost much at all. Right, so if you're a great boss who provides meaningful work and skills development and a great corporate culture, that doesn't cost you anything, but it makes a big difference. So what I decided to do was to look at how happy employees are at a company. So this was the paper that Hamid referred to at the start. So why do I do that? First, why do I look at employees, not the environment or customers? Well, that's because employees are critical in nearly every company, whereas the environment is certainly important, but it might not be so important, let's say, if you're in the tech industry, you don't have as much impact on it. So that's why I look at employees. Why do I look at this list of the 100 best companies to work for in America? Because this list is really thorough. What it looks at is not just how much you pay your workers, but what it does is it surveys 250 employees at all levels and asks them 57 specific questions about the level of employee satisfaction. Now, there's another powerful thing about it, was that this paper was around since 1984. So I had tons of data. So why is that important? Well, responsibility is a pretty new thing. So most data sources have only been around for the last 10 years. And if I showed you that responsibility only paid off, let's say between 2010 and 2019, you might think, well, that was a boom time for the economy. Maybe right now in a pandemic, we shouldn't care about responsibility. But because the study started in 1984, I had things like the financial crisis, like September the 11th and the collapse of the internet bubble, so I could make sure this holds in bad times as well as good. And as we know, correlation does not imply causation. So I had to do further tests to ensure that it's employee satisfaction that leads to better performance, rather than better performance allowing a company to spend on employees. So after all that, what did I find? I found that the 100 best companies to work for in America delivered shareholder returns that beat their peers by 2.3 to 3.8% per year over a 28-year period. And that is 89 to 184% cumulative. So simply put, companies that treat their workers well are not just being moral and ethical, they're also being good for business. They're also generating higher returns, because when you treat your workers well, that grows the pie and makes the company more productive and more profitable because of employee motivation. Now, one challenge that you might have is, well, that was a study that I published 10 years ago. Is this still worth anything now? Because if markets were efficient, then as soon as this study was published, then investors should start trading on it, and therefore there won't be any money to be made, particularly given how much attention is paid to ESG nowadays. But interestingly, Hamid and his co-author just replicated my study 10 years later. First, they found that my study continued to hold for the original period. And that's really important, because we've seen the replication crisis. Sometimes people fake their data or do some stuff which is dodgy. They were able to find the same results as me for those 28 years. But what was really interesting is they looked at the 10 years that happened even after I finished the study. And what they found was that the results continue to hold. And that's kind of crazy, right? So why isn't it that people are investing in responsible companies? And the answer, and this is going to link to my final section, how do we evaluate responsibility, is that people might be looking at the wrong things. Yes, people know we want to look at how well a company treats its workers, but they may look at only quantitative factors, like how much you pay them, or how much employee turnover is, or the number of new jobs created. And that does not capture things like, are you giving meaningful work and skills development? And so what this means is to truly assess responsibility, we need to have a much deeper approach rather than just looking at a couple of statistics. And so that's going to be what I'm going to look at in the final part of my talk. How do you evaluate responsibility? Now, you might think, do I have a wrong word here? Because shouldn't it be, how do we measure it? But in fact, I don't think responsibility is something you can measure. It's something that you can evaluate. And what is the difference? Well, evaluation involves measurement, it involves numbers, but it involves more than that. It involves a qualitative assessment. So let's look at this. And this is one of the things where I think the ESG industry has got stuff wrong. So previously, many people will implement responsible investing by the idea of divestment or exclusion. What they will choose is some responsibility criterion. And if you fail that criterion, then you cannot be invested in. So maybe you're in a bad industry like alcohol. Maybe you don't have a diverse board. Maybe you have a high ratio of CEO pay to worker pay. And once you are, if you don't cross any of those red lines, then you are part of the investable universe, and then you're chosen purely out of financial reasons. So again, ESG, that's a red line. It's a barrier to entry. But as long as you don't cross any of those red lines, then you are part of the universe. And then people then forget about ESG. They choose from the universe based on financial numbers. But there's a lot of problems with this. So one of them is that it considers only one factor, and so can lead to halo effects. And halo effects are where you form an opinion on a company just because of one thing. So it could be that a company does not have a diverse board, but does so many other great things to serve society, yet is excluded. Or it could be that this focuses on only quantitative measures, but not qualitative ones, and therefore it can be manipulated. So you might be a company who does not care at all about diversity, but you just put a token minority on the board to tick the box. Now, those two things you might have heard of previously, but I'd like to focus on the three things here a bit more carefully. And this one is a really important one. It ignores the strategic context. Sometimes ESG factors may not be material. So what do I mean by this? Like, climate change is the order of the day. It's really important. Obviously, everybody here cares about it. However, to sell a stock because it's not contributing towards climate change is not right, because sometimes in some industries that might not be the most material factor. So let's say tech, for example, there your impact on the climate is so small, it doesn't matter whether you're a leader or a laggard in it. Maybe much more important are things like data privacy, making sure there's no cyber addiction and cyberbullying and so forth. The next point here is that many of these measures focus on do no harm rather than actively doing good. And that's why it was so important for me to start with highlighting what it means to be a responsible business. Many of the measures you look at, carbon emissions, water usage, employee turnover, injury rates, they're all about the harm that a company does, but not how much value they actively create. So Vodafone launching M-Pesa, that would never help you improve your metrics. Why? Because it doesn't help reduce your carbon footprint. It might actually increase it, because to launch M-Pesa would have taken something. The final thing here is a bit more nuanced, but what it is a really important one that many people ignore. It confuses valuation issues with preference issues. So what do I mean by this? So there are some people who make the following argument. I am never going to invest in a company without a diverse board, because diverse boards make better decisions. But even if that's the case, even if diverse boards make better decisions, then what this means is a company with a non-diverse board, maybe it's going to be worth 10% less because of the lack of diversity. But this never means that you shouldn't invest in it. Why? Because it might be that the other factors about a company are so attractive that even with that 10% discount, it's still worth it. Or maybe the stock price is so cheap that even after applying that 10%, it's actually still worth it to invest in the stock. So even if you believe that these ESG factors are bad, that should never be a reason to exclude the company. It should just be something that feeds into your valuation alongside all of the other factors. Now, there could be a separate reason for not investing in a non-diverse company, and that is a preference issue. You might just think it is morally wrong to invest in any company without a diverse board. And that's fair. And that would lead you to excluding the company totally. But most people who make the argument for diversity focus on the valuation reason, not the preference reason. And if so, it should never be something to exclude you. It should just be something which factors into your decision. So this is why the best way I think that you should invest responsibly is through integration. So what does that mean? That means considering ESG factors alongside financial factors when you value a stock. So it's not that ESG is something that can exclude you, that I'm never going to invest in the company because it doesn't have a diverse board, but instead we consider all of these things together. So when you are forecasting the future profits of a company, yes, take into account traditional factors, like how good the products are, how good the management team is, but also take into account how satisfied employees are, what its impact on the environment is, because those things will also affect the customer reputation. So what we do, and this is now me putting my practitioner hat on, I serve on the Responsible Investment Committee for a large asset manager, and I've done that for 6 years, is what we do is a net benefit test. So we ask, does the company provide a net benefit to society? So what this means is we're taking all of the things that a company does, the good stuff it does, and the bad stuff it does, across all of the different stakeholders, and we make an overall assessment. So if we were to look at Amazon, we would say, yeah, what's bad is that they don't provide great conditions for their workers. Now, for some investors, they just refuse to invest in Amazon because of their treatment of their workers. But then we would also say, well, let's look at the positives. Like what they do is they make products available to everybody for low prices. They make customer reviews available. Also, you can sell your products secondhand, and that's much better than selling them or that's much better than dumping them. And also for employees, they do now pay pretty decent wages. So what we're going to do is to look at everything together and overall make an assessment. Now you might say, well, the problem with that is it's subjective. It depends on your opinion. Some people think that actually, well, Amazon's working conditions are so bad that that outweighs how they treat their customers. Others will say the opposite. But I would say nearly everything important in life is subjective, right? So when you decide who to hire for your company, some people might have higher test scores, but might have worse soft skills. Is there any way of seeing what outweighs the other? There's no calculation, but we just have judgment here, and this is something that we are needing to use. And so what's the interesting parts of a net benefit test? Well, what does it include? First, it includes excellence. So this is not a traditional ESG factor, but a key determinant of how much a company creates value for society. So some of the best things that you can do is just to be excellent at your job. I've done some work with a train company in the UK, and they're thinking about, well, do we want to give to charity, this charity or that charity? And I say to them, run the trains on time, But if you run the trains on time, that has so much benefit to society. It means that people can get to jobs. It means that people can live out of the city because they know they can commute in. Just by being good at your core business is so much more valuable than any of these other things that you could be doing. The second thing I highlight is it considers comparative advantage. So what do I mean by this? So Hamid asked me to talk about, how do you know as an investor who is truly responsible versus truly greenwashing? And apologies if you know this, but what is greenwashing? This is pretending to be responsible when you're actually not. And so I think one of the most important things is what are you doing to serve society linked to your skill and your expertise? Right, so after things like George Floyd was killed, people said, oh, let's just give money to Black Lives Matter. Now, I'm clearly somebody who cares about racial equality, but anybody can give money to charity, even if you don't really care about diversity. Whereas when Vodafone uses M-Pesa, that is linked to its expertise. Why? Because its expertise is telecoms, and so it can use that expertise to launch this mobile money service. So when you do something which is serving society, it has to be linked to what you're good at. Otherwise, somebody else should be doing it, not you. The final thing is something I've slightly alluded to before, but let me just go through this in more detail, is it considers materiality. So what is that? Well, there's loads of problems in the world. There's 17 Sustainable Development Goals for the United Nations. But it's not a company's responsibility to solve all of the world's problems. You have to focus. Now, I want to talk about the word purpose, because that's something which has been a bit of a subtext to my talk, but I haven't formally defined it. Often people think a purposeful company is one that serves society. It serves everybody, customers, workers, suppliers, the environment, communities, and investors. Now that sounds fantastic, but it's really unrealistic because there are trade-offs. If you are an energy company and you shut down a polluting plant, that's good for the environment, but it's bad for workers. So you can't serve everybody. So I'm defining purpose as why a company exists, who it serves, its reason for being, and the role that it plays in the world. And that might sound quite idealistic, but it highlights the need to be focused. Your purpose cannot be to do anything, just everything. Just like your purpose as a person, when you leave EDHEC, you're not going to be a doctor and a lawyer and a teacher and a banker. You might choose to be one of them. So where does materiality fit in? This is about the importance of focus. So this is the final study that I'm going to go through. So what this is a materiality map, which goes through every industry and highlights what are the most material stakeholders. So let's look at the first column, which is extractives and minerals processing, or mining. Right, the environment is really material, because if you are Rio Tinto and you blow up Juukan Gorge, that's going to be really bad for your business. But let's look at banks, financials. Here, the environment isn't so important in that you don't use raw materials from the earth in order to do your business. You are not affected by things like floods, at least not directly. But what matters much more is social capital, things like selling practices and product labeling. If you're Wells Fargo and in a fake banking out scandal, that's really bad. So why is that important? So this study here takes perhaps the best known ESG data set, and it looks at companies that do well across the board. They will do well across every dimension. And they find that these companies beat the market by 1.5% per year, but that's insignificant, so they actually don't outperform. So actually, the idea that ESG always pays off is not borne out by the data. But then when they redo this, and they look at companies that do well on material issues, but do badly on immaterial ones, they do beat the market. So a responsible company is not one that is all things to all people, but focuses on a couple of things and make sure they do them really well. And so this is why it's really important to evaluate companies, not just with data, but just the boots on the ground approach of actually speaking to management. And that's what I'm going to end with before going to the questions. So what I have in the book, I'm not going to go through all of them, is just a few questions that investors should ask management. I've not just invented this out of thin air. I've done this after speaking to investors for over several years. And let me just give you one example. What is your company's purpose? And what did you omit from it? Why aren't you doing certain things? Because in order to help some people, you can't help everybody. But I love giving this talk here to EDHEC, even though those are not my students. How can I do this? I don't give much talks within the PhD program at LBS. I much more care about master's students because I care about the real world rather than just PhD students. Similarly, can you give examples of areas in which you pursued excellence, but to create value for society, not just profit? So you would, if you're Vodafone, you'd say M-Page was an example. Here's, I'm going to wrap up now, but as Harry kindly said, I wrote this book last year, and why I did this is for far too long, people had thought about responsibility as being only a nice to have extra, only having a moral case. I wanted to write and explain there's a strong business case here. This is why I, as a professor of finance and as a former investment banker, am so passionate about responsibility, because it's good for the business as well as being good for society. Now, this is based on a lot of evidence, but a lot of academic research is written in rather turgid journals and quite unpleasant to read. So what I wanted to do was to break this into simple language for a practitioner audience. And so I hope this might be a resource to some of you. Okay, well, thank you so much to everybody for their attention. Let me now hand back to Hamid to do the Q&A.
Thank you very much. Yes, so I can also certify that it's always on my desk, the book, and I read it. It's a great book. Okay, and actually all the students, they have to, I guess, read this for a business. We have a business social responsibility course. You guys have to all read this amazing piece. Okay, thank you very much, Alex, for all the info you gave us, the great talk. And now the students, you can all either raise your hand and I will unmute you so that you can talk, or you can write in chat. Please go ahead so that we can have a communication, and if you have any questions. So maybe I first start by just asking if 1-2 questions, and as the students' question comes, we take those. So Alex, ESG scores. So that's a big thing. So you mentioned briefly that, well, part of these things are, of course, subjective, right? And we observe, very huge disagreement across data providers on the ESG scores. And what is the future? Do you think that they may converge, or do you think that these things is going to be always kind of subjective, and 5 years from now we still see most likely disagreement? And if there is disagreement, then what about all these people that they use this data as an input for their investment? If they just mechanically they follow those scores, what would happen?
I think it's a really important question. So ESG ratings, I'm sure you all know, those who have professional rating agencies will try to rate a company's ESG. And so there's some people that say, well, there's disagreement between them and therefore they're not reliable. But hopefully in the future, when there's better data, everybody will agree. But I don't think that's the case, right? Why do people disagree? It's not just having different data. Even with the same information, people might still disagree. So one of the things I did when I was young, I played for the England chess team. With chess is not like poker. Poker, you have imperfect information. You can't see other people's cards. But with chess, everybody has the same information. You can see all the same pieces, but different people will agree or disagree as to what the best move might be. And indeed, we see this with other types of ratings. So equity analysts like Goldman Sachs and Morgan Stanley, they will rate a company as being a buy or a sell. All of these equity research analysts will disagree with each other. You will not have consensus. But I think that's a good thing, not a bad thing, because another word for disagreement is diversity of opinion. And so what this means is that as an investor, you will read the buy report and the sell report, and you will think, well, who do I agree with? And I think this should be the same with ESG ratings. right? So I think what people do, which is by mistake, is they just look at whether the rating is good or bad, and then mechanically, as Hamid says, buy something or sell based on that. Instead, the value of the report is not just the rating, but the underlying analysis. So the way to use that is to read them and understand the reasons for the argument. Sometimes you'll agree, sometimes you'll disagree, but use it for the content, not just the headline number. I don't think even if we have perfect data, you're ever going to have perfect agreement. But what I want to find out is why the rating agencies disagree, and that to me is much more interesting.
Okay, great. So now one more question related to that. So imagine that even we kind of agree or on you know, some companies are bad, and the fact that some of these funds and investors, they are selling those companies. So we are sometimes happy that these guys are selling those companies. They kind of divest, and does it really make those things society a better place? That action of selling those companies, because ultimately someone buying those shares, right? And maybe in fact it comes in the future, you know, if it pushes the prices down because of the high selling pressure, maybe in fact there's a future, you know, higher future returns to make on those companies. So what is your take on that?
Yeah, I think this is a really important point. So many people think ESG investing involves selling companies that are bad, boycotting them. Let's say if you're in the oil and gas industry. Now, boycotting works because if you're a customer, because if I boycott my local restaurant because they have abusive staff, then they lose my money. Like nobody might step into place. But when you're selling a company stock, you can only sell if somebody else buys. So you're not actually depriving a company of capital. I think this is really important because there are people who, if you are an investor and you're investing in energy companies, they will really think that you're irresponsible. So Cambridge University had people digging up their lawn because they own some fossil fuel stocks. But that's not the right thing to do, because if you actually own a company, it could be that you engage with them and you can try to turn them around. So as I'm sure you'll know, Engine number one, this small investor, they put 3 directors on the Enron board, and they could only do that because they had shares in the company, had a seat at the table. On Monday, I had lunch with the Archbishop of Canterbury, and that's not to name drop, but it's because he, as Archbishop, is really responsible for the church's money. Church obviously really cares about climate change, but as he said, I believe in conversion, not surprisingly, but he would rather buy shares in these energy companies and hold them to account for actually trying to decarbonize. And I think that's a much better way of doing things rather than the blanket buy or not buy strategy.
Thank you. So Remy has, I allow you to talk. I think you have a question.
Yes, can you hear me?
Yes, absolutely.
Yes, first of all, thank you for your presentation. That was really interesting. My question is about what you call the net benefit test.
Sure.
Do you have examples of companies that have a positive rating to this test? And my second question is that you talked during your presentation about how to evaluate responsibility, and you basically said and finished your presentation by saying that well, it depends. It depends on point of view, and that's, well, it's finally it depends on the people and the point of view of that. But as you may know, the IPCC report that has been recently published say that there is a causality between CO2 emissions and GDP growth. And during all your presentation, you talked about other factors than profit, but you always had in mind and included profit as one of the factors in the companies. You talk about climate change, but don't you think that the moment that if we take into account profit and we stay with this factor, we will always be taking the wrong path to face climate change?
I think these are really important questions. So let me start with the first one. So what are the companies that do well in a net benefit test? So what a net benefit test is, we do this purely internally. So we're not publishing the results of it. But let's say Unilever would pass the net benefit test because we're saying they're trying to make sustainable living commonplace. They have this program to reach 1 billion people through hand washing programs and so forth. So those will, I think, be the things that we discuss, which goes into it. The second issue that you have on climate is a really interesting one. And it's a really interesting one because actually the data here is the opposite to what many people claim. So I wish this was not the case. I'm just stating what the data shows. But there's a paper recently published in the Journal of Financial Economics, one of the top journals, finding that the more you pollute, the higher the shareholder returns of a company. Now, there's many people who argue, well, climate change is a material risk. Polluting companies are going to be suffering. But actually, this has not been the case for decades, as actually the more polluting companies are generating higher shareholder returns, a bit in the same way like tobacco stocks have done well over the past few decades. So what this suggests in terms of the best way to solve climate change, well, I think it's through heavy government regulations. I think it's through governments having a carbon price, to having carbon taxes and so on. So why I think the ESG industry is, I think, a little bit misleading by saying, oh, we're just going to dump carbon stocks and that's the way to decarbonize, is that is not a powerful tool, as Hamid was saying. And if indeed they're saying, oh, don't regulate as companies, as the government, we've already got it in our hands, just leave it to us as investors, we're going to achieve decarbonisation. I don't think that's right. I think we need heavy government regulation in there. Now that you can also have got individual actions by investors, but I think the most important thing here is for the government to regulate and ensure that companies are paying for the damage that they are having to the environment, because then you would have the results in the right way, which is the more polluting companies are doing worse, and therefore there would be the incentive to decarbonise. But right now, without actually a sufficient carbon tax, you're not going to have those incentives. So I think that is the first order thing that needs to change.
Okay, great. Maxime, you have also a question?
Thank you for the lecture, for the presentation. Maybe I've missed something, so don't judge me. Just want to ask, to clarify then, or maybe to extend this. I see that if we, compare returns, we see that these companies outperform. But if I try to model this, how does it work? Do investors somehow include benefits for them in terms of various societal benefits? They add them to returns companies get, or how does it work? Like how fundamentally, why do these companies should be priced higher? Hopefully, hopefully it's understandable.
No, that's a good point. And actually for this, I'm going to fold in Andre's question. So Andre asked, well, why am I looking at shareholder returns? Because rather than just profits. And why I don't look at profits, Andre, is because of this reverse causality issue. So if I showed that employee satisfaction was linked to profitability, it's not clear whether employee satisfaction causes higher profits, or is it profits cause a company to be spend more in its employees? But because the stock return is something in the future, then I can show that if employee satisfaction today leads to future higher stock returns, then it's more likely to be causality. Now you might think, well, why don't I just look at future profits? And the answer is I actually do, but with a twist. So what I look at is, if a company has high employee satisfaction today, how will its profits be in the future? But importantly, I need to compare the future profits to what analysts expected they would be. Because we already know that certain companies like, let's say Google, will make high profits. But if the stock price is to go up, it must be that the profits are higher than what people thought. So what I did is I compared the profits of companies to what the market was expecting beforehand. And what I found was that these companies were always making higher profits than people expected. And so that answers Andrew's question. Then back to Maxime's question, why is it that the stock return goes up? It's because in the future, the companies who have higher employee satisfaction, they deliver higher profit results. And why? Because if your employees are more motivated, more productive, then you're going to have higher productivity, higher innovation, and all of these things feed through to profits. So the stock return is linked to profits, but what we need to look at is unexpected profits doing better than what the market thought you would do.
Okay, thank you so much.
Great. So maybe so in the Q&A chat, I see that Matthias is asking about the green bond market. And so it seems that there's a lack of global standards, and it's talking whether this may lead to complex structured products and could lead to a financial bubble. Do you have any thoughts on these, Alex?
Yeah, so certainly global standards for certain things, like how do you count carbon emissions or water usage, or what do you measure? Those are important. And so if you have some standardization here, that would certainly help. However, what I will say is that there are some people who think, well, let's have completely standard metrics. And as soon as you have completely standard metrics, then ESG will work perfectly. But I don't think that's the case. So one really standard metric that you have is quarterly earnings, right? Earnings are standardized. That's why we have generally accepted accounting principles. But to just invest based on quarterly earnings is really problematic, because this means that companies will do things to manipulate their earnings, such as cutting research and development. In the US, they launched about 20 years ago, No Child Left Behind. And so that allocated funds to schools based on test scores, standardized test scores, and then people just were teaching to the test. And so similarly here, if we had certain standardized metrics and investors use them mechanically, so you would be invested in if you cut your carbon emissions, then that would mean that a company might shut down a polluting plant, even if there are lots of people who have jobs there, because you're going to be doing better on those measures. So the problem with any sort of measures is that you're never going to measure qualitative factors like meaningful work and skills development. You're always going to look at the measures. So we certainly want standardization, and that will help in the green bonds market. But I would caution against an approach to ESG investing, which is purely driven by the data. You will also need to take these qualitative factors into account.
Great. Shreya, maybe you?
Yes, my question was that when you gave the example of M-Pesa, do you think they could face pressure in the future for monetizing on something that should have been a charity?
Well, the question, yeah, great question, Shreya. So the question is should it be a charity? And I would say no, right? So Vodafone is a profit-making organization. Things that it does to create value for society, it is not unfair for them to profit from it, because this is it costs a lot of money to develop this, and if you're not able to make profit, then you're not able to give returns to investors, and you'll not be able to fund future investments. So I think loads of things that people do, like sell pharmaceuticals, offer financial services, offer education, right? You have to pay for your education. Those things have a cost, and so you should charge for that. The question is, well, are they charging absolutely outsized prices? And I believe that the answer is no, is that yes, you have to pay for it, but it's not that they're trying to reap as much as you can. So a fair price needs to be greater than zero. It's not as much as you can get away with, but it has to be fair for both the supplier, but also the customer.
Okay, thank you so much.
Thank you. Alex, there's a question Adrien is asking. How would you translate the ESG factors in valuation exercise? So I guess means like let's say discounted cash flow valuation is asking whether it's on the discount rates or somewhere in the cash flows or both.
Yeah, I actually had seen this, so I just typed an answer right here because I've written an article about this. And I'm really glad you asked that question, Adrian, because this is something that a lot of people get wrong. And so this is the problem with ESG, is that there's many people who have never cared about ESG previously, who now just jump on the bandwagon and start talking about it. So Mark Carney, the former governor of the Bank of England, he's obviously a fantastic monetary economist. But ESG is a really different issue. And he says, oh, ESG, well, these things will, if you're bad at ESG, you're going to have a higher cost of capital. But that is crazy, because also people think that if you have a bad ESG, you're going to have lower shareholder returns. But those things must be the same. The shareholder returns are the cost of capital. So you can't have it both ways, right? So if bad ESG is going to lead to lower shareholder returns, it will also be a lower cost of capital. So what I've done in this post is just to lay out why I think the best way to model ESG is through the cash flows, not through the discount rate. So if you are indeed a company with bad ESG, your cash flows are going to be lower because your employees will be less productive. You might be at the risk of fines, but actually it's not clear which way it will go in terms of the cost of capital. So this article is hopefully going to lay this out in more detail.
Thank you very much, Alex. We are out of time and there's lots of questions. So I think hopefully they can maybe reach to you later on or so if they are really want to get an answer.
Yeah, they just feel free to drop me a note on LinkedIn. I'll be very happy to get back to you. Thank you for all the interest.
And before we finish, maybe a personal advice to our students. Alex, you are one of, I think, not one of the most productive person I have seen or been in contact with in my life, who is a professor doing a lot of research, teaching, sport, music, many things, giving so many talks and consulting, all those sorts of things. And I suppose you get enough sleep also. My students, they, sometimes we talk about productivity, we have struggled to run, 1-2 courses throughout or so. If we want to follow a sport, we can't do any other things. So is there any quick advice on these things, how to be productive for them?
Yeah, so I actually gave a public lecture on time management, and so I've just put the link here. And so this is on time management productivity tips. And one very quick thing there is just to be able to say no. So we often think, okay, there's fear of missing out. Let's say I would like a job in fund management, but let me also recruit for investment banking and private equity and all of these things as well, because my friends are doing it. But I think just to know what to say no to is really important. And so what I have here is the lecture itself. You can watch the video, but if you don't have time, there's the notes to the lecture. If also on that website, if you click on it, says PDF transcript, that's the notes. And I hope that will help somebody.
Thank you very much. It was a pleasure to have you again, Alex, and thank you very much. Have a great day.
You're very welcome. Thanks so much, Hamid. It's been great as well this year. Thanks so much for all of the questions. Sorry I couldn't get to all of them, but as I say, if you just drop me a note on LinkedIn, I'd be really happy to get back to you. Take care, everybody.
Thank you. Bye.